Hi friends, in this particular video we are going to understand how to evaluate the stocks. So in this particular video we are going to provide you detailed analysis. So in this particular video we are going to cover three main points. One is how company decides pricing structure of stocks. This is very important for you to understand how a company decides pricing structure of stocks, how you should be careful about while analyzing such kind of stocks. Second thing is important points to consider while making a perception about any company, because sometimes the stock value makes us some kind of in a kind of confusion, and we really need to know what are the important points to consider while making any perception about any company. And the third, which is very important, that is how to analyze stocks or company effectively, because once you have decided to go with any company, then you should be knowing about what are the checkpoints that should be over there and what are the possible risks that you might be dealing with and that are really hidden with you. So just we will cover all the 3 points one by one. So coming to the first point, which is how the company decides pricing structure of stocks. So it is very interesting point. Basically, whenever a company has listed itself in stock market, they are looking for some kind of investment or capital investment. So let us understand from company point of view, because the company seeks some investment. So the company target is to raise, for example, a company targets to raise 100 crore of capital from shares. So the company has listed itself in the share market. Now the company has two options: selling out 10 crore shares at a price of rate 20 per share, or it may have the option 40 crore shares at a price of rate 5 per share. Now, if you see both the points, the company has really achieved its target, but has the really has the company been really providing something extraordinary? For example, if you see here, you might be having some perception that this company is having more share value, there is 20 rupees per share, and second option says 5 rupees per share. So we might be going for 20 rupees per share, but that is a wrong perception, because the company is ultimately going to achieve this target, and in order to achieve this target, it's going to take either one option or second option. So never be confused or never be generalizing this thing, that if stock market value, or you can say this face value is more, then you are going to invest or you are going to take your step with this thing. So always you should always be aware about this company strategy, how the company is in the market, in the stock market. So coming to the next point, which is about how you can consider while making a perception about any company. For example, if you have 10 number of companies and you want to choose which one is best you should be going forward to, or which one has got something that matters for your return or investment returns. So now the most important criteria to check this thing is profit per earning, which is P by E ratio. So price per earning. So you are going to get this thing checked by price per earnings. So what is price per earning? It's a valuation ratio of the company's current share price compared to its per share earning. So let's explain it with an example. For example, if a company is currently trading at 43 rupees a share, and the earning over the past 12 months have been rate 1.95 rupee per share, so the profit per earning ratio for the stock value would be 22.05, which is a ratio of this trading value as well as this earning value. So here you would be able to find out profit per earning. Now this is very important criteria. Once the profit per earning, uh, the better the company is having, or you can say any organization is having, um, better profit per earning, the more you are going to get in a safe investment. So whenever you are uh, having any perception, basically it's about perception about any particular company while you're going to trade with that. You should always be careful about how you are going to judge them, and you should always be judging them with their profit per earning. So that is one of the very important point how you are going to judge any of the company while it's worth your investment or not. What's the past performance look like with the trade value is going to have right now. So never make any wrong perception with the face value of the at the moment. Just check this thing for price per earning, and that's going to make you sure about your investment. Now, the third and most important part, which is how to analyze any company effectively and avoid risks. So here we are going to explain some basic but most important checkpoints that you should be taking care of while analyzing any of the company. Because once you have just as you have just seen in the last slide, that profit per earning is the main criteria that you are going to evaluate. But for example, you have just picked 10 companies with of which profit per earning is in the favorable condition, and you might be considering to invest in those in out of these 10 companies. So now what should be the main checkpoints to the basic analysis? The first one is how well the company is doing. Now you really need to get more info about the company, how it's doing, whether it's getting profit over the last 12 months, 2 years, whether it's what is the growth rate and how it is going to achieve in the future market. All these things you really need to know about how the company is doing, how the products of the company are performing in the market. The second thing is what is the financial position of the company, because this is one of the very important part that decides your investment, whether you are going to get good return or you are going to get negative manner. Because of the last 5 years or for how many years has the company been able to make significant profit? This is again which is linked to the first point. Now once the profit is more and more with the company, obviously it's going to have more share value. But apart from that, it's going to have its their own investment, their own capital, because they are having significant profits. And if they are having significant profit, then of course they are going to give you better returns about the investment that you have made. Now let us take an example of any company. For example, let us say this is a steel company. If we consider about its last 5 year performance, now we really need to think about what has been the trend of the company profit, whether the company's profit is increasing or declining or how it has been. And the second thing you really need to consider is what the capital investment the company is having, or what are the future projects it might be having, what is the future of the company, how the products might be performing in near future. So that's really one of the very important part, this particular part. Now the third thing is what is the kind of appreciation that past investor in the company stock have got. Again, this is really directly related to your uh, decision of investment, because whatever the kind of result the past investors have got, that might be the same scenario with you. Now you really need to think about those factors, what has been behind the stock's results, but you really need to find out this history. That's really going to help you. And the last very important point is the company offering any sort of dividend? Yes, if the company is offering or not, That's really again one of the very important points. So these are the basic and most important checkpoints that you must be analyzing before going to any of the company or making any perception about particular company. Because if you had checked these four main points, then you can say that you had done good analysis about a particular company. And if you had done this four basic parts analysis, then you can't say that you had done a good analysis and you can go for the safe investment. So these are the four safe points. So to summarize our this video, would like to again talk about what we have learned here. We have learned here what is the pricing structure of the stocks, how the pricing company decides its pricing structure, and how you should be making the perception, because that's really important point. Second thing is we recently learned about important points to consider while making a perception about a particular company. What is the methodology to make the perception about the company's profitability or stock market results. The third thing that we just learned about is analyzing stock companies effectively, as well as avoiding our risk while doing any investment. So see you in the next video. We hope that this video has been helpful for you.